Okay, so before we get into anything today, I need you to just sit with this number for a second. $73.6 billion. That's not the US defense budget. That's not some massive corporate bailout. That is the amount of money that Japan, one country, spent in a single month just to keep its own currency from completely falling apart. And Wall Street barely even flinched. And that, honestly, that's what scares me more than anything else here. Now look, I know what you've been seeing on your feeds lately. You've probably scrolled past like 5 or 6 videos of people in Tokyo doing luxury hauls, designer bags, Michelin-starred meals, hotel rooms that cost what you'd pay for a fast food combo in the States. And it looks incredible, right? Like, why does Japan suddenly look like this insane deal for American tourists? And everyone's sharing it, everyone's going viral with it, and the comment sections are full of people like, I'm booking my flight tomorrow, and that's fine, honestly. Have fun. But here's the thing, and this is what nobody in those comment sections is actually explaining. The reason that Tokyo looks so cheap right now is not because Japan decided to be generous. It's because their currency is in crisis, like a genuinely serious, historically significant crisis. And the way they're trying to fix it directly affects your money. Sitting right here in the United States. So let's actually talk about this. All right, so let's go back to April 30th. The Japanese yen hits 160.72 per dollar. Now, if that number doesn't mean anything to you, here's why it matters. 160 yen to the dollar is basically the red line. Japan's finance ministry has made it pretty clear over the years that when the yen crosses that threshold, they step in. It's like a break the glass moment. And sure enough, when it crossed 160, Japan's finance minister authorized what's called a currency intervention, which sounds really complicated, but in the simplest possible terms. The Japanese government went into the open market and started buying their own currency, using dollars, to push the exchange rate back up and make the yen stronger. In the first wave alone, on April 30th, they dropped an estimated $35 billion in a single day, and the yen still didn't hold where they wanted it, so they kept going. And earlier this month, Japan's Ministry of Finance released the official numbers for the full intervention window, April 28th through May 27th. Total spent $73.6 billion, which is 11.73 trillion yen, by the way, if you want to feel even more dizzy about this. And that is a record. That is the single largest currency intervention Japan has ever done in 1 month. Bigger than what they did in 2022 when the yen cracked before. Bigger than anything in 2024. This is unprecedented. So, okay, natural question. Did it work? And, well, kind of, not really. After blowing through $73.6 billion, the yen is still sitting around 159 per dollar today, which means they're still basically one bad headline away from sliding right back past that 160 line. Goldman Sachs actually ran the numbers on how much reserve firepower Japan has left and concluded they could sustain around 30 more interventions at this scale. Which sounds like, okay, that's a lot, right? But think about it. They just burned $73.6 billion in 30 days, and the yen is still teetering on the edge. This is not a fix. This is a finger in a dam that is starting to crack. Okay, so now, and this is the part I really need you to pay attention to, here's where this becomes your problem. Not Japan's problem. Yours. When Japan does a currency intervention, they are not pulling money out of some government checking account. What they actually do is sell dollar-denominated assets and use those proceeds to buy yen. And the biggest dollar-denominated asset that Japan holds? US Treasury bonds. Japan is, as of March 2026, the single largest foreign holder of US Treasuries in the entire world. We're talking about approximately $1.19 trillion. And Federal Reserve custody data shows that during the intervention period, the Fed's foreign official account holdings dropped by nearly $9 billion in a single week. That's directly consistent with Japan liquidating Treasury positions to fund their yen purchases. Japan's own reserve data confirms it. Their US Treasury holdings dropped by nearly $48 billion just from February through March. And that was before the biggest rounds of intervention even started. So, think about what's happening here. Japan sells US Treasuries. That extra supply hits the market. What does more supply do to a market? It pushes the price down and the yield up. Higher Treasury yields mean a stronger dollar. A stronger dollar means a weaker yen. A weaker yen means Japan has to intervene again. And then it starts all over. It's a loop. It's a self-reinforcing cycle, and nobody, and I mean nobody on mainstream financial media, is really talking about this with the urgency it deserves. Now let me give you the root cause, because the loop itself is only half the story. The Bank of Japan's policy rate right now is 0.75%. The US Federal Reserve's target rate is 3.5% to 3.75%. That is a gap of nearly 3 full percentage points between those two countries. And for years, big institutional investors and hedge funds have been running what's called the yen carry trade. Basically, you borrow yen at near zero interest rates, you convert those yen into dollars, you park them in higher yielding US assets, and you pocket the difference. Easy money, right? We're talking about trillions of dollars in positions built on this trade. And as long as that rate gap stays this wide, this carry trade keeps running, which creates constant selling pressure on the yen and constant buying pressure on the dollar. It's structural. It's baked in. And here's the trap Japan is in, because it's a really ugly one. They can't raise rates fast enough to close that gap. Japan's debt to GDP ratio is over 260%, the highest of any developed nation on earth. If the Bank of Japan starts raising rates aggressively, it blows up their own domestic bond market and makes their debt service costs completely unmanageable. They literally cannot afford to pay their bills if rates go up too fast. And on the other side, the Fed isn't cutting anytime soon either. So Japan is stuck, can't raise rates, can't let the yen collapse. All they can really do is burn through reserves and pray that the dollar weakens on its own. That is not a strategy. That is hope. And hope is not a plan. So let's bring this all the way home for you. Because this isn't just a Forex story or a story about tourism in Tokyo. When Japan sells US Treasuries at this scale, it is not a neutral event. Treasury yields move on supply and demand like literally everything else in a market. When the world's largest foreign holder of US debt starts liquidating, that pushes yields up. And higher Treasury yields mean higher mortgage rates for Americans, higher corporate borrowing costs, tighter financial conditions across every asset class. And here's the wild part. The Federal Reserve doesn't even have to lift a finger. Japan, just by trying to defend its own currency, is functionally tightening financial conditions in the United States. That is how interconnected this all is. And it's not just Japan. CNBC reported this month that both Japan and China are leading a broad retreat by foreign governments from US Treasuries. China's holdings are now at an 18-year low. The two largest foreign creditors of the United States are selling simultaneously. And yet Wall Street is still out here calling this a stable market. I genuinely don't know what they're looking at. Okay, so let me give you 3 things to actually watch going forward, because I don't want to just leave you with a scary story. I want you to know what signals actually matter here. First, watch the yen. If it breaks back above 160 and holds there, Japan will intervene again. More Treasury selling, more upward pressure on yields, more tightening that the Fed never ordered. Second, watch the 10-year Treasury yield. That number is basically the price of money in America. It drives everything. Your mortgage rate, the valuations on growth stocks, corporate debt costs. And a move higher in that yield doesn't have to come from the Fed. It can come from foreign selling. It can come from what Japan is doing right now. Third, and this one is the one that could actually get violent fast, watch the Bank of Japan. Because if the BOJ is forced to raise rates meaningfully to try to defend the yen, the carry trade starts to unwind. Institutions that have been borrowing cheap yen to buy dollar-denominated assets suddenly have to sell those assets to pay back their yen loans. We got a preview of this back in August 2024. The BOJ raised rates by less than half a percentage point. Tiny move. And the S&P 500 dropped more than 3% in a single day. A bigger unwind would hit way harder than that. Way harder. And that's the thing about dollar strength that I think gets lost in the conversation when it's mostly forex traders and tourists talking about it. It is not just a number on a chart. It is a wrecking ball that moves through the global financial system. And the $73.6 billion Japan just spent is proof that even G7 central banks, the biggest, most powerful central banks in the world, are not immune to the damage a strong dollar can cause. So what's the actual takeaway here? The takeaway is this. Japan didn't spend $73.6 billion because they had some grand currency strategy they wanted to test out. They spent it because they had no choice, because the strong dollar is breaking things, and every single Treasury bond they sell to fight back against that dollar makes it a little worse. Not just for Japan, but for every American with a mortgage, a 401k, a portfolio, or a savings account that's earning rates tied to Treasury yields. This is all connected. It is all one system. And the fact that this story is not leading every financial newscast right now tells you something important about how this information flows and who it flows to first. The shadow data, the reserve figures, the Fed custody accounts, the BOJ policy minutes. That stuff moves markets before the headlines catch up. By the time this is front page news, the smart money is already repositioned. And that's kind of the whole reason I do this every day, because understanding the mechanism, not just the headline number, but the actual loop, the actual cause and effect, that's what gives you an edge. Not a guarantee, obviously. Markets are messy and weird and humbling, but a real structural understanding of why things are moving the way they are. That's the difference between reacting and actually being prepared. So keep watching the yen, keep watching the 10-year, and keep paying attention because this story is not over. Not even close. If you found this useful, and I genuinely hope you did, hit that like button. It helps more than you think. And subscribe so you don't miss what comes next. Because if that yen breaks 160 again, we're going to have a lot to talk about. I'll see you in the next one.